Thanks to everybody for being here. I'm going to wait just a few more minutes and just see if I know there's a couple of members who told me they were going to be here. Just give them a couple more minutes to show up. Thank you. All right, we're going to go ahead and proceed. I'll call to order this meeting of the Subcommittee on Economic Growth, Tax, and Capital Access of the Small Business Committee. Thank you to everybody, especially to our witnesses for being here. 5 years ago, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law. With its passage came an onslaught of new regulations. As we are aware, prior to Dodd-Frank's passage, there was a commonly repeated phrase of too big to fail, and a sense that our economy had been hurt due to large financial institutions' inappropriate actions. This law was meant to curtail the inappropriate and risky actions of these too big to fail banks and increase financial stability and transparency while providing greater consumer protection. Today, we are not seeing the benefits promised by the proponents of the law. The economy is not rebounding exponentially. We are not seeing financially stronger and smarter banking. Instead, as we will hear from our witnesses, today the small guys who did not create the problems are the ones who are suffering. The losers in this equation are small businesses, both the everyday Main Street business that has trouble getting a loan and the local bank that has to hire compliance officers instead of getting capital into the hands of local small businesses. These small financial institutions, our community banks and credit unions, are traditionally the individuals who lend to small firms. Recent research has found that community banks provide over 50% of the loans to small businesses, especially in rural communities like my district. The burdens created by Dodd-Frank are causing many small financial institutions to merge with larger entities or shut their doors completely, resulting in far less options where already there were not many options to choose from. We've all heard that Dodd-Frank contained exemptions to meant to ensure that financial institutions under a certain size would be ineffective. The creators and proponents of this legislation have repeatedly assured folks that they truly understand the importance of small financial institutions and that these entities were not why the law was created, nor were the proponents intending to harm them. Unfortunately, as we will hear today, even the smallest financial institutions are feeling the effects, the burdens of this law, and not just this law, but exponential growth in all federal banking regulations as it trickles down and creates substantial regulatory burdens. And at this time, I'd just like to put up a couple of graphs that exhibit the point that I'm trying to make here. You know, all of us, Republican, Democrat, House, Senate, the President, say repeatedly, I've heard the President say over and over again that we need to simplify and streamline regulations affecting small business. I think there's a graph before this one. Now, this is the first one? Okay. Well, if you'll look, that's all the regulations that have been issued. This is a study done by the Mercatus Center that looks at mandates and prohibitions in regulations. And if you look at this, you'll see that all of the regulations issued under the Obama administration, including Obamacare, EPA, the war on coal, all these other things, and then the regulations under Dodd-Frank there in the lighter colored line, the regulations issued just under Dodd-Frank outnumber the regulations issued in every other area of the federal government. Next slide, please. All right, there was another slide that I've got a copy of here, but it shows that in the 6 years since the president has been in office, that the number of the number of regulations issued by the administration is higher than any administration since Richard Nixon in 6 years, and we still have 2 years to go. Excuse me, on this slide. Yeah, that's the first slide I wanted there. Yeah, can you make that bigger? Yeah, if you'll look at the top, you'll see the top line is the regulations issued under the current administration, and then underneath that, in 6 years, and you'll see every president since Richard Nixon under there. And this administration has already outpaced the number of regulations, despite the fact that they say that we need to streamline and simplify regulations applying to small business. You know, let's look at let's not just hear the words, but let's look at what's actually happening. Okay, next slide, and then you'll see the regulations, which are more than any other administration in the last 40 years. Most of those regulations are under Dodd-Frank, and in fact, we're just over halfway through with the rules that are supposed to be implemented under Dodd-Frank. So many more tens of thousands of regulations ultimately will be issued under this law, and those regulations obviously have a stifling effect on banking. Next slide, please. Dodd-Frank was passed under the guise of too big to fail, that we needed to do what we could to prevent large institutions from becoming so large that they were a threat to our financial system. This graph is a graph of the assets held by the large banks. And if you'll see in that red line is the percentage of total banking assets held by large financial institutions. And since 2010, it's hard to read, but the total banking assets in the country since Dodd-Frank was passed, held by large financial institutions, has increased from 39% to about 42 or 43%. And I think this is the top 5 largest U.S. banks only. So Dodd-Frank has been a failure in terms of preventing these banks from becoming too big to fail, its primary mission. Next slide, please. Let's look at the effect on small banks. This is the number of banks being formed in the country. From 2000 to 2010, the number of banks being formed in the country averaged about 100 per year. And if you'll look since 2010, when Dodd-Frank was implemented, I think the average is about 1 or 2 banks per year, which is a scary, scary thing for our economy, because small banks are typically the new banks, and they're the primary lenders for small business. and small business employs 75% of the people in this country. So should we be surprised, with no banks being formed, that small businesses struggle to find capital, access to capital being one of America's biggest assets in the past? Should we be surprised that our economy continues to limp along at 2% instead of 4%? Next slide, please. This is the number of business startups and business closings, and you will see since 2009 that for the first time since the Great Depression, that business closings outnumber business startups in this country. Could that perhaps be tied to a lack of access to capital? I think that's very likely. I don't think this is coincidental. And again, this is small businesses going out of business at a faster pace than small businesses are being created, and these businesses are the primary employers of the American people. Next slide, please. This slide is, okay, the primary source of wealth building in the country for the last 50 plus years, 100 years, has been home ownership. And you can see that home ownership has taken a nosedive and continues to dive, and due largely to these new lending restrictions under Dodd-Frank. Home ownership now stands at the lowest level in 48 years. Next slide, please. And this is participation of people in the workforce. And you can see that it took a nosedive after the recession and continues to, it's now at record levels, percentage of people who are outside of the workforce in this country. So we've got the highest number of people that are outside the workforce in 30 years. Back up a slide. The lowest home ownership in 50 years. Back up a slide. The slowest rate of net business formation in 80 years. Next slide. Back up a slide. The lowest rate of bank formation in 80 years. Next, back up a slide. So this is not a record, an economic record that anybody should be proud of. And Dodd-Frank plays a big part in this equation. So with that, I want to thank all of our witnesses for being here this afternoon. I look forward to your testimony. I now yield to the Ranking Member Chu for her opening remarks.
I want to thank all of you for being here today. Today's hearing will focus on the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 and the impact of these regulations on small financial institutions and on access to capital for small businesses. In 2008, our country faced one of the worst economic downturns in history. In the midst of this financial crisis, the U.S. lost 4 million jobs, 7 million people faced foreclosure, and many entrepreneurs abandoned their dreams and small businesses closed their doors, believing that they would never open again. After taking extraordinary steps to stabilize the economy, Congress enacted the Dodd-Frank Act in July 2010 to address the loopholes that caused the collapse. The bill established strong new standards for the regulation of large leveraged financial institutions and made the protection of consumers seeking mortgages and credit products a top priority. While this legislation was primarily directed at the largest financial firms, we often hear that small banks are impacted primarily due to the high costs for compliance. And it is clear that these small lenders on Main Street are not the ones responsible for the financial crisis. Community banks and credit unions are on the front lines of community lending, providing personal, familiar services to small businesses and entrepreneurs. These entities should not be forced to carry the burden of new regulations. For these reasons, critical measures have been put in place to ensure that any new regulatory burden on the small banking community is properly mitigated. First, many of the Dodd-Frank Act provisions only apply to institutions with over $10 billion in assets, leaving 98.2% of all banks in the U.S. largely exempt. Second, new regulations created by the Consumer Financial Protection Bureau that do apply to small financial institutions are subject to the Regulatory Flexibility Act and the Small Business Regulatory Enforcement Fairness Act. Now, in the midst of this, small business lending has increased. In fact, According to the Thomson Reuters PayNet Small Business Lending Index, access to credit has continued to improve for small businesses, reaching its highest level ever in June 2015. Moreover, small business lending is up 19% over the same period in 2014, pointing to steady economic growth. The Federal Reserve has found lending standards for small firms have eased considerably since the recession, while loan balances at community banks have increased nearly 9% in the last year alone. And finally, even Small Business Administration lending has reached record levels. SBA is currently on track to make 65,000 loans totaling over $26 billion in its 7A and 504 programs combined. In fact, the National Federation of Independent Businesses reports a historically low 3% of small business owners are unable to fulfill their capital needs. Critics of Dodd-Frank point to the decreasing number of small financial institutions as proof of regulations that are too burdensome. But it is crucial to remember that the decline in the number of community banks did not begin with Dodd-Frank. For the past 30 years, the number of community banks in the U.S. has been declining at a rate of 300 per year for the past 30 years. And 80% of these losses were actually due to mergers and consolidations. There is no doubt that the regulations implemented by Dodd-Frank will impact many facets of the financial industry. And there is also no doubt that the economy has been improving at a greater pace since its passage. Private employers have created 12 million jobs, and unemployment has been cut in half. The housing market is recovering, and small business credit has returned to pre-recession levels in many sectors. Both Democrats and Republicans have introduced legislation to make technical corrections to the bill that will support community banks. However, moving forward, it is essential that we legislate prudently and avoid allowing big banks to exploit the genuine concerns of small institutions to promote legislation that benefits Wall Street at the expense of the American people. Today, 8 years after the housing bubble burst, small business is creating 2 out of 3 new private jobs and resuming its position as the economic engine of our country. The success of these businesses depend on their access to capital and credit, and small financial institutions like the credit unions and community banks represented here today play an extensive role in lending to them. As both lenders and borrowers, small businesses have much at stake when it comes to financial regulatory reform. It is my hope that the testimony today will add important perspectives on the interaction between Dodd-Frank and Main Street, and we can all learn. I want to thank the witnesses for being here today, and I yield back.
Okay, if committee members have an opening statement prepared, I ask they be submitted for the record. I'd like to take a moment to explain the timing lights to you. You will each have 5 minutes to deliver your testimony. The light will start out as green. When you have 1 minute remaining, the light will turn yellow. Finally, at the end of your 5 minutes, it will turn red, and there'll be a certain amount of flexibility allowed there. I ask that you try to adhere generally to the time limit. Our first witness is B. Doyle Mitchell, Jr., President and CEO of Industrial Bank located here in Washington, D.C. Industrial Bank was founded by Mr. Mitchell's grandfather in 1934 and is currently the 6th largest African-American owned bank in the country with $370 million in assets. Mr. Mitchell has worked at the Industrial Bank since 1984. Mr. Mitchell is testifying on behalf of the Independent Community Bankers of America. Welcome, sir. You have 5 minutes, and you may begin.
Thank you, Mr. Chairman and Ranking Member Chu, for the opportunity to testify before this subcommittee. As you stated, my name is B. Doyle Mitchell, Jr. I'm President and CEO of Industrial Bank, headquartered in Washington, D.C. The bank was founded by my grandfather at the height of the Great Depression in 1934. We just celebrated our 81st birthday. And we are the oldest and largest African-American commercial-owned bank in the Washington metropolitan area. We have over 100 employees, and I testify today on behalf of 6,000 community banks represented by the Independent Community Bankers of America, thank you again for convening this hearing. In addition to being a member of ICBA, I'm also former immediate past chair of the National Bankers Association, which is a trade association for the nation's minority-owned and women-owned financial institutions. There is an extremely important segment of community banks like mine that were founded to serve minorities, communities, and historically underserved areas often ignored by larger financial institutions. Community banks play a critical role in providing small business credit, and yet the vital partnership between community banks and small businesses is at risk today because of the exponential growth of regulation. Dodd-Frank is really just the pile-on of regulation. And in a few short years, the nature of community banking has fundamentally changed from lending to compliance. I was speaking to my CFO 2 days ago, and he was talking about the growth in the call reports going from 60 pages to 80. I believe regulatory burden has contributed significantly to the loss of 1,300 community banks since 2010. While, yes, there has been acquisitions and consolidations, many community banks that I come in contact with have just thrown their hands up and given up and sold. Good news is there is a solution, and ICBA's plan for prosperity is a regulatory relief agenda that will allow Main Street small businesses to prosper. A copy of the plan is attached to my written statement. Now, I come in contact with hundreds of bankers on an annual basis from 4 different associations. So while ICBA has put this forth, I can tell you I don't get any argument from other bankers. The plan includes 40 recommendations, nearly 40 recommendations covering major threats to community banking, and I want to focus my comments on the plan's mortgage reform provisions. Home equity is often an entrepreneur's greatest source of capital, and they should be able to tap into that to start or expand a business. However, it's often hard for self-employed individuals to document their income as required by the CFPB's Qualified Mortgage, or QM, rule. QM is a safe harbor that shields a lender from draconian litigation risk. For most community banks, QM effectively puts a tight box around underwriting and loan terms. Because it's inflexible and does not give bankers discretion, such as ours, to use his or her judgment, QM is cutting off small business credit. We believe any mortgage community bank holds in the portfolio should be QM, and we sell loans, but we sell about 50, 60, sometimes 70% of our loans, and the loans we hold in portfolio are those creative loans that QM would effectively stop from occurring. We're encouraged by the bill's introduction in the Senate and the House so far. 2 bills in particular best represent the scope of the plan for prosperity. The CLEAR Act, H.R. 1233, sponsored by Representative Blaine Lukemeyer, includes the portfolio QM provision that I described, in addition to other provisions designed to preserve community bank mortgage lending and servicing, reform bank oversight and examination, and provide relief from redundant annual privacy notices. The second bill is H.R. 1523, introduced by Representative Scott Garrett, which would provide community banks with new capital options to strengthen their viability. Minority banks are always looking for additional capital, and most other community banks are as well. We encourage you to co-sponsor these important bills as well as other bills embodying the plan for prosperity provisions. One last item I'd like to note is that ICBA believes community banks should be excluded from CFPB's forthcoming small business data collection rules. Small banks didn't create those problems, and they should apply to the institutions, the larger institutions that actually do. This rule will require information reporting on every small business loan application, much like HMDA, which is very, very tedious. HMDA at this point probably has nearly 100 different data points, and if you miss one, the examiners will call you in violation of law. Thank you again for the opportunity to testify. I look forward to your questions.
I'm pleased to introduce our next witness, one of my constituents, Scott Eagerton, the president and CEO of Dixie's Federal Credit Union, which is headquartered in South Carolina's 7th District and serves all of Florence and Darlington counties. This small credit union has 7,000 members and nearly $42 million in assets. Mr. Eagerton is testifying on behalf of the National Association of Federal Credit Unions. Thank you for making the journey here today, sir. You may begin.
Good afternoon, Chairman Rice and Ranking Member Chu, and members of this subcommittee. My name is Scott Eagerton, and I'm testifying on behalf of NAFQ. I serve as the President and CEO of Dixie's Federal Credit Union, headquartered in Darlington, South Carolina. NAFQ and our members, thank you for holding this hearing today. During the consideration of financial reform, NAFQ was concerned about the possibility of overregulation of good actors, such as credit unions. This is why NAFQ was the only credit union trade association to oppose CFPB having rulemaking authority over credit unions. Unfortunately, many of our concerns about increased regulatory burden of credit unions have been proven true. The CFPB's primary focus should be on regulating the unregulated bad actors, not creating new burdens for good actors like credit unions. While it is true credit unions under $10 billion are exempt from the CFPB examination and enforcement, all credit unions are subject to the CFPB rules. The impact of the growing compliance burden is evident in the number of credit unions that continue to decline, dropping more than 17% in the second quarter of 2010. 96% of those smaller institutions were like mine, below $100 million in assets. At Dixie's, our compliance cost has risen fivefold since 2009, from about $20,000 a year to $100,000 annually. We spend more today on compliance than we do on loan loss. During financial reform, the National Credit Union Administration moved to a 12-month exam cycle for credit unions, increasing costs for both the agency and for credit unions. We now have 4 full-time staff members who spend 2 weeks preparing for an exam, 2 weeks during the exam, and 2 weeks following the exam. The average cost in wages is about $30,000 a year, $30,000 per exam. The financial crisis is now over. We believe the NCUA should use their authority to return back to the 18-month exam cycle for healthy and well-run credit unions. New regulation on top of new regulation has hindered Dixie's business and our ability to retain top talent. We've had several staff departures due directly to these frustrations. Most of our staff has indicated that they do not want to participate in real estate lending because of the constant change and regulatory uncertainty. Through August of this year, Dixie's has already spent over $20,000 for system upgrades and software licenses. This doesn't include the time to set up the software and train on it. That costs roughly an additional $7,500. Discussions with NAFQ member credit unions led to the creation of the NAFQ 5-point plan for regulatory relief, which is outlined in my written testimony. One area where the CFPB could be most helpful to credit unions would be to use its legal authority under Section 1022 of Dodd-Frank to exempt credit unions from various rulemakings. Congress can also bring greater accountability and transparency to the CFPB by making structural improvements to the agency. For example, enacting H.R. 1266 of the Financial Product Safety Commission Act of 2015. It would replace the sole director of the agency with a bipartisan 5-person commission. The qualified mortgage rule is a prime example of a regulation that was unintended with unintended consequences. Because the rule was written with a one-size-fits-all, it has significantly limited member access to a variety of mortgage products. We decided the liability risk wasn't worth it, which this has resulted to our mortgage portfolio shrinking from 60% prior to the crisis to 30% today. Despite a strong track record, we are now making fewer mortgage loans in South Carolina. Finally, credit unions are not immune to the regulatory creep from Dodd-Frank. Despite strong credit union performance during the financial downturn, the NCUA board proposed a new risk-based capital system for credit unions. NAFCU maintains that this costly proposal is unnecessary and will further burden credit unions. We believe that Congress should enact legislation HR 2769 to stop and study proposals before moving forward. In conclusion, the Dodd-Frank Act has a significant impact on credit unions despite not being the cause of the financial downturn. We would urge members to support credit union regulatory relief efforts as outlined in my written testimony. Additionally, the subcommittee should also encourage regulators to provide relief where they can without congressional action. Thank you for the opportunity to share my thoughts with you today. I welcome your questions.
Thank you, sir. Our third witness is Marshall Lux, a senior fellow at the Mosavar Rahmani Center for Business and Government at Harvard University's John F. Kennedy School of Government. Mr. Lux worked in the financial services industry for over 30 years. We look forward to your testimony, sir. Please begin.
Thank you. Chairman Rice, Ranking Member Chu, and members of the subcommittee, thank you for the opportunity to speak with you today. In doing so, I will draw heavily from The State and Fate of Community Banking, which is a working paper I co-published in February 2015 as a senior fellow at the Mosavar Rahmani Center for Business and Government at Harvard, with Robert Green, a research assistant at the center who is seated directly behind me. Before I begin, let me be clear that the views expressed here do not necessarily reflect those of any organization, and that either Robert Green or I are affiliated with, and instead stem from independent scholarly research we have undertaken to understand the critical issues facing America's financial system. Capital access for small business remains a critical pillar of economic vitality. Members of this committee are likely aware that small business account for roughly 1/3 of enterprise employment. But the current size of a business matters less than its potential to expand. And capital access is critical to achieving such growth. As of 2012, banks were the primary financial institution for 85% of small businesses. In our February working paper, Mr. Green and I found that an astonishing 51% of small business loans were from community banks. Now, why is this? Community banks leverage interpersonal relationships in lieu of financial statements and data-driven models in making decisions. As Federal Governor Tartullo has noted, credit extension to small firms is an advantage in which the relationship lending model of community banks retains a competitive advantage. It means that community banks are of special significance to local economies. Yet the state of small business banking today is different than that of several years ago. For starters, the number of community banks, banks with less than $10 billion in assets, has declined rapidly in recent years. It didn't start with Dodd-Frank. In mid-1994, there were 10,329, and in mid-2014, there were only 6,094. Similarly, since 1994, community banks' share of U.S. U.S. banking assets has decreased by more than half to 18%. More concerning to this committee is the post-crisis decline in the volume of bank loans to small business. In the 4 years before the crisis, from mid-2003 to 2007, outstanding bank loans to small business grew 25% and 15% in community banks. Yet outstanding bank loans to small business is attributable to small community banks, which realized a 17% fall. During this time, small business lending by larger community banks remained relatively flat. What factors are at play here? Non-bank lenders, while growing rapidly and increasingly playing a viable role in both credit and the overall U.S. economy, have and will only fill some of the gap left in the wake of less community bank small lending. The vast share of small business lending is still performed by banks. So while these non-bank firms and technology-based platforms are a factor, community banks will retain will remain a critical part of small business lending, even if or as the market share of alternative credits grow. Instead, a major cause of decreased community banking small business lending is our nation's tepid economic recovery. Labor force participation is a 10-year low. Quarterly GDP has averaged just 2.5% in the last 2 years. In August 2015, survey of small business by the National Federation of Independent Banks reinforced this concern. It found that 49% of respondents were on the credit sidelines with no good reason to borrow. But the most troubling fact is that the firms seeking credit may not be able to access it. As former small business head Karen Mills and a colleague recently noted, while measuring the credit gap is difficult, the evidence strongly suggests that there are acute impediments to accessing capital for many creditworthy small businesses. Dodd-Frank shrinks credit access because of its sheer scope. It stands to increase financial regulatory restrictions by 32%. As a recent paper published by the Federal Reserve of Richmond said, banking scholars have found that new entities are more likely when there are fewer regulatory restrictions. The current bank, a lack of new bank formation, inherently hampers credit access. Furthermore, a recent IBA study found that 21% of banks report new regulatory burdens as a factor. For 83% of small banks, compliance costs have increased at least 5%. This capital is not being deployed in our economy. Some will argue that because consolidation has occurred, Dodd-Frank is not a factor in declining community banking. But in fact, large-scale regulatory accumulation within the banking sector has simultaneously occurred with rapid consolidation. Regulatory restrictions within Title 12.
If you could wrap up your testimony.
Sure, absolutely. Grew every year. Reforming financial regulatory process is critical. Mr. Green and I proposed several strategies to do so. Credit benefit analysis brings about transparent deliberation and regulators to avoid unintended consequences. While Dodd-Frank was intended to focus on large banks, there is trickle down. Community banks have recently reported held to the same stress tests and capital standards as large financial institutions. In conclusion, small businesses clearly play a critical role in bringing about heightened U.S. growth, and community banks today are, and for many years have been, essential sources of credit. The reliance upon community banks from a variety of factors, an emphasis on relationship-based lending, non-standard lending, geographic necessity. 1 out of 5 people lives in a county with only one community bank. Certainly, market factors may diminish the role of community banks in small business lending. Unfortunately, regulatory pressures such as those brought by Dodd-Frank are undermining the competitiveness of community banks.
Thank you, sir. We're going to have to wrap it up with
Okay.
it. Thank you. I now yield to Ranking Member Chu for the introduction of her witness.
It's my pleasure to introduce Ms. Julia Gordon, Senior Director of Housing and Consumer Finance at the Center for American Progress. Gordon has written extensively about the Dodd-Frank Act and has been cited in the New York Times, Wall Street Journal, and the Washington Post, among others. Prior to joining the Center for American Progress, Gordon managed the single-family policy team at the Federal Housing Finance Agency and served as Senior Policy Counsel at the Center for Responsible Lending. Ms. Gordon received her bachelor's degree in government from Harvard College and her JD from Harvard Law School. Welcome, Ms. Gordon. We are so happy to have you here today.
Thank you so much, and good afternoon, Chairman Rice and Ranking Member Chu and distinguished members of the subcommittee. I really appreciate being invited to discuss the very important topic of small lenders and access to capital. Small lenders, as everyone's discussed today, play a critical and unique role in meeting America's credit needs. They often serve non-metropolitan areas poorly served by larger institutions, and they focus their lending on everyday customers such as small businesses and families. Over the past 5 years, a number of indicators of health of small banks have shown consistent improvement, financial performance, overall health, the overall lending. It is absolutely certain, though, that the overall number of small institutions continues to decline. As Ranking Member Chu noted, this trend began decades ago, and the pace of that decline, kind of the slope of the line on the chart in my testimony, has not been affected by any individual regulation or piece of legislation, including the Dodd-Frank Act, which of course is a very large set of regulations. Now this makes sense because the pressures driving the decline in small bank are not just regulatory pressures, although of course that is a factor. It's also unlikely that a decline would have been triggered at the moment of signing of the Dodd-Frank Act because it took quite a while for the provisions to be implemented. In fact, they're not all implemented yet. Even the CFPB was not open for business until a full year after the act was passed. Other factors driving this decline all surround the simple fact that in today's complex financial market, size matters. The vast majority of small banks that have exited the industry have actually merged or consolidated. Less than 20% of those exits have been due to failure or simply exiting the business entirely. So those banks are still out there doing business in a larger form. Now, these pressures are because larger financial institutions engage in a wide variety of activities and serve a broader range of markets, and that better insulates them when particular business lines or markets are experiencing difficulties. They can rely on economies of scale. A very big factor and one of the pressing challenges facing all lenders today is the rapid pace of technological change and innovation. Today's customers demand everything from online lending on mobile devices to cloud-based systems where documents and other items can be stored. And these demands can be tougher to meet for small lenders, many of which have aging and inflexible technology infrastructures and limited staff and financial resources for projects of that nature. There's also the weak demand that Mr. Lux talked about, that the economy is still recovering from the worst downturn since the Great Recession. And because of the terrible mortgage lending in the run-up to the crisis, the loss in home equity, which is generally the largest source of capital for starting small businesses, was hit very, very hard, and there's still a lot of negative equity out there, and people are reluctant to tap their equity. So, while of course regulatory compliance is part of the challenge, policymakers have recognized that, which is why many of Dodd-Frank's provisions don't actually apply to the smaller institutions. Enhanced supervision only applies to the very largest institutions, and only 4 out of approximately 5,900 community banks must undergo stress tests. Small lenders also are exempt from many of the new rules governing mortgage lending, which gives them much more flexibility than larger lenders. And if they were willing to take advantage of this flexibility, they could see a significant competitive advantage in the marketplace. Now, there are no regulation is perfect, and we have supported a number of small regulatory changes that could reduce compliance costs without weakening consumer protections or endangering safety and soundness. And there's a targeted regulatory reform package supported by the ranking members of both the House Financial Services Committee and the Senate Banking Committee that would ease some of the burden, relates to things like the exam schedule that I believe Mr. Eagerton mentioned. Unfortunately, some of the more sweeping legislative proposals, particularly the very large package that passed the Senate Banking Committee, uses the rhetoric of helping small banks to advance the regulatory reform agenda of larger banks. And that could actually increase and accelerate that chart that Chairman Rice showed earlier of the big banks having more business and cement the advantages that those institutions have relative to the smaller institutions. So we need to be very careful about that. If we really want to help small lenders, what we need is a strong, proactive agenda to help upgrade technology, improve marketing, and gain access to cloud-based resources that can help smaller institutions work more like larger ones. We also need an agenda to support entrepreneurship and formation of small business, whether it's providing people with higher quality education, portable benefits that prevent job lock, upgrading investments in
Yes, ma'am.
science
You
and
can be wrapping
technology,
up.
and welcoming new entrepreneurs through our immigration system. An agenda like that would address the obstacles facing small business without putting America's taxpayers on the hook again for risky and unsustainable lending practices. Thank you for inviting me today, and I look forward to your questions.
Thank you, ma'am. I have quite a number of questions. I learn so much every time I hear you speak. I have a couple of general questions for the guys in here on the ground that are doing the banking work. And I'm going to start with you, Mr. Mitchell. Do you think you were adequately regulated before the financial crisis? In other words, has additional regulation made your business safer, more efficient, more profitable? Are you serving your customers better as a result of this additional regulation?
Absolutely not, Mr. Chairman. In fact, even before Dodd-Frank, I think we were over-regulated. I've been in the business for 30 years, and I've seen periods of additional regulation, and it always increases. It always increases. My colleague spoke a little bit about the amount of money that he spends on regulation, and what we spend, and we're only $370 million, dwarfs that. Excuse me. And I don't see any benefit to the customer. Community banks take care of their customers anyway. That's what we do. So the answer is no.
All right. So, and you lend to a broad spectrum of people. How has have the new tightened lending requirements, have they affected your ability to lend to the top 1% to the wealthy people? Or
No.
would you say it disproportionately affects the middle class?
You know what? It affects lending to all people because many times we think about the regulations while we're actually trying to look at and underwrite a loan. You know, in the back of your mind, you're always thinking about what if the regulators do this.
When you
what
say
if.
many times, give me a percentage, somewhere between 0 and 100.
Half.
Half? You think about regulations half the time when you're making a loan.
Yes.
And is it more common that you would be prevented from making a loan to a wealthy person or to a middle class person?
It's always tougher on those that are low, moderate, and middle class.
Hadn't the new lending restrictions taken away your ability to loan to somebody who might have been on the border?
No question about it.
And would you say that disproportionately affects a minority community?
Absolutely.
Mr. Eagerton, I'm going to go to you next, sir. Do you think you were adequately regulated prior to the financial crisis?
Absolutely.
And do you think that all these new regulations have made your bank safer, have made it more efficient, have allowed you to better take care of your customers?
It's probably one of the biggest threats that we face today. I spend about $9,000 a year on loan loss reserves for real estate loans. We spend $120 to make sure we're in compliance.
All right. And would you say that these regulations affect more your ability to loan to wealthy people or to people who you might otherwise have been on the borderline and you might have taken a chance on?
The latter, for sure.
So you think it disproportionately affects the middle class
Absolutely.
and minority borrowers?
Absolutely.
Mr. Lutz, can you generally describe for me, we were talking earlier about the SBA kind of filling the gap for these community banks. Mrs. Chu referred to the SBA making 65,000 loans. Do you think the SBA can fill the gap that these community banks are leaving open?
Not at all. Nor can, thank you. Nor can these new lenders that are emerging Karen Mills has a wonderful paper that you all should read, if you haven't, on small business lending. But there is no question, the SBA has never been able to fill the gap, and they're not going to be able to fill a very large gaping gap.
Do you think the additional regulatory burden, not just by Dodd-Frank, but the cumulative banking regulation since the financial crisis, the pendulum has swung, right? It had swung too far to be too loose, and clearly it swung the other way. Do you think that shaves points off of our GDP? Do you think that negatively affects our economy?
Yeah, I do. I mean, the amount of, we're talking about small banks, but and small lending, but even for the larger banks, it's a huge amount of money that has transitioned out of the economy for, I'd argue, no good reason. And when you try to interpret a law that's, 6 times larger than Basel III, they created in a in a heartbeat a bunch of laws that are yet to be even interpreted. So that's really important to recognize, that a lot of Dodd-Frank hasn't been implemented, and it just gets worse and worse. I frankly think it's a drag on the economy, and the sort of the work that we're doing. Which
If you
is
can
done,
wrap up, my time's up.
Okay.
Thank you, sir. Thank you very much.
Sure.
I now recognize Mrs. Chu, the ranking member.
Ms. Gordon, small businesses are the backbone of our economy, and small lenders are largely responsible for getting small businesses and entrepreneurs the capital they need. Many critics of the Dodd-Frank Act point to the declining number of community banks and credit unions as proof that the regulations are too burdensome. However, you state that Dodd-Frank isn't the cause of the decline. Can you tell us why you believe this is true, and what are the factors that have led to the decline?
Oh, I spoke about some of this in my earlier testimony, and just to hone in on a few things. We went through a very, very bad financial crisis, and that impacted a variety of things. For one thing, the decline in home equity was monumental. Home equity is a key resource that people use when they're starting or expanding home businesses. Even now, as we're coming out of that period of negative equity, consumer confidence remains shaky, and we see, particularly in the mortgage market, people unwilling to borrow against their homes, or concerned that they're actually not back in positive equity. I will say there is an area, something we can all agree on, is that in terms of mortgage lending, the pendulum has swung too far in the opposite direction. And what's interesting is many of it isn't really, much of that is not so much because of the Dodd-Frank rules per se. What you hear from Fannie and Freddie and FHA, which are the major secondary market channels for mortgage lending right now, is that banks themselves are placing what we call overlays on the credit box established by those secondary market entities, because those banks themselves are feeling very, very risk averse, no doubt due to the pressures that we've all been through over the last decade. And it's particularly interesting in this committee where, as you know, starting a small business is a risky thing, and really, people have to take chances. And we are in an environment now where our lenders don't appear to take any chances at all. And that is not so much about regulation, because there actually haven't been enforcement actions against the type of institutions represented at the table here. In fact, these institutions are exempt from most of the mortgage rules. They're exempt from parts of QM. They can still continue to make balloon loans. They don't have to deal with escrow accounts for higher priced loans. They can, if they're holding loans in portfolio, they don't have to adhere to the QM debt-to-income ratio restriction. So they've got a lot of flexibility that they could use to compete. But what I've heard when I talk to lenders is that their lawyers and their risk officers are telling them they just, oh, don't do it, don't try it. And that's not a question of the rule needing to be changed. That's something about the environment that we need to change. I think we should all be very open to ensuring that the regulations are applying to the right group. If there are some exemptions that need to be widened to, bring in a few more institutions with higher asset sizes because of all this consolidation, we should look at that. Again, things like exam schedules, make sure they're not too burdensome. But some of the core changes of Dodd-Frank, like that requiring that lenders check whether a borrower can pay back the loan before they make that loan, it is a shame we ever had to regulate about that. That should have been common business sense, but it was widely disregarded, and that led to the crisis. So we need that rule.
In fact, I wanted to ask about that. Low-income and minority communities were devastated by predatory mortgage lending in the years leading up to the housing crisis. How are these communities better off today with the ability to repay and qualified mortgage rules that we enacted under Dodd-Frank?
Well, what we know today is that when someone gets a mortgage, we're probably supporting what I call home ownership rather than just home buyership. The importance of the home is that you can afford it and you can sustain it over the life of the loan. So people getting loans now, especially under the new stringent requirements, are much more likely to be successful and to build wealth. We do need to take some actions to reduce these overlays so that more people can get into the market, and a lot of that has to do with working with Fannie, Freddie, and FHA to give more certainty to lenders about when they're going to get a buyback request.
Okay, thank you. I yield back.
Representative Kelly.
Thank you, Mr. Chairman, and thank you, witnesses, for being here. While I was home in the district in August, I visited all 22 counties, which I have, and I visited lenders, bankers, credit unions, in all of those counties where they exist. And over again, I was shown the effects of Dodd-Frank on these small banks. In Mississippi, we have nothing but small banks. And the new regulations that are coming out, that are about to come in, are 5 or 6 3-inch binders worth of new regulations that my small Mississippi banks must comply with in order to run their business. Many of them who don't have as many employees with you, Mr. Mitchell, who has a small bank, but not as small as some of the ones that I represent. In Mississippi, small businesses, and specifically our banks, our small banks, are the cornerstone of every single town. It is the basis of why we have a town, and if there's not a bank, there's not a town. Mr. Eagerton, the same way. With every military institution I've ever been on or installation, the credit union there is the cornerstone of one of those military installations. That being said, Mr. Mitchell specifically, can you tell me in any way that Dodd-Frank, since its enactment, and the regulations that currently exist and those that are coming, can you tell me how they make banks more accessible, how they make lending more fair, how they make you more responsible as a bank to the people that you lend money to, how it has made it more time sensitive in the way that you respond to your end customer, and how it protects our customers better?
Thank you, Mr. Kelly. And I in my travels, I come across, as I said, a number of banks, and certainly I've come across a number of CDFIs in the state of Mississippi, and I feel their pain as well. Dodd-Frank had a lot of great intentions. It really did. The problem with Dodd-Frank is you cannot outlaw and you cannot regulate a corporation's motivation to drive profits at all cost. So while it had a lot of great intentions, in over 1,000 pages, it has not helped us serve our customers any better. Just like the institutions in your state, community banks, we are there for our customers. we actually really do care about our customers. Dodd-Frank was intended for maybe 50 to 100 institutions. It was not intended for mainstream institutions, minority banks around the country, like the one in Newark, New Jersey, City National. Mr. Payne, your father was a great individual. So it has not helped. It has not helped. It's only increased our cost. And if my cost of complying were as low as Mr. Eagerton's, I'd be happy. But our cost of compliance is probably approaching $500,000.
I actually was a loan closing attorney in a former life. It's been many, many years because it was too complex for me in 1999 when I closed my last loan, and that was way before all this.
Do you have any idea what it's going to be like on October 1st?
I don't want to know. That's why I came to Congress, I think. But that being said, do you think that more regulation and more paperwork and thicker loan packages that take a longer time to implement are better or worse? Do they cost more or less for the end consumer, the person who is getting the loan, Mr. Mitchell?
It costs way more. The loan package is probably this thick, and if anyone in this room bought a house 20 years ago, you already remember how many documents that you had to sign, how many documents you had to read. I bought my first house in 1989, and it was a chore as a banker for me to get through it all. I only hope I can stay in my house forever now.
And one final question from a consumer standpoint. That thick regulations, a thick amount of a loan closing package that you have right now, do the majority of your customers, when they're signing those loan document papers, do they understand what they are signing, or are they relying on an attorney who, in most cases, is not representing them but representing someone else? Do they understand what is in all those regulations that they're signing that is supposed to protect them?
Absolutely not. Absolutely not. It's not any clearer about what they're signing. In fact, it's even more cumbersome for them now. We do mortgage loans, and I was sharing with someone before the hearing. The unfortunate thing is we have done mortgage loans for 81 years. We're seriously thinking about getting out of the mortgage business, and that would be a tragedy because we do a lot of lending for minority customers.
Thank you, Mr. Mitchell, and I'll yield back the balance of my time, Mr. Chairman.
Thank you, Mr. Chairman. Ranking Member Chu, thank you for holding this hearing today. And although I wasn't in Congress when Dodd-Frank passed, I do believe that our second great recession in 2008 really required Congress to step in and protect the consumer. And there may be unintended consequences from Dodd-Frank that hurt access to capital for our small businesses. But I think at this point, I don't think we should be throwing out the baby with the bathwater. I think we should work together to fix some of those provisions that would help our small lenders. But while some of you think that the recession is over and the crisis is past, I will tell you, I represent people in my district who did lose their homes and who lost their jobs and have not recovered yet. So I'm not convinced that we need to ease regulations as yet. We know what happened before when there were no regulations, and certainly the banks and the mortgage lenders took advantage of people. I was going to ask Ms. Gordon, and you touched on it a little bit, but I do worry that the lobbying effort underway to reform Dodd-Frank is coming from big banks under the guise of helping small banks. In fact, the legislation that passed through the Senate Banking Committee earlier this year is very broad and would lift major regulations off of big banks. Honestly, and again, you touched on it, but who do you think will benefit more from the Senate Banking Committee's Dodd-Frank reform legislation, small community banks or big banks?
Absolutely, the big banks. We'll just take as an example the question of exemptions from the qualified mortgage requirement for loans held in portfolio. And as we know, loans held in portfolio, the incentives tend to be aligned better than for loans that are sold into the secondary market and securitized. the community banks represented at this table already have that exemption, and there is a proposal out there to raise the threshold of asset size for that exemption. I'll note something interesting there, which is I think when we're changing these definitions, if we do broaden some of these definitions, it might make sense to look less at asset size per se than actually at what kind of business the institution engages in. The FDIC has some criteria they look at about what kinds of business that you're doing, so that folks doing that kind of bread and butter business, lending to small businesses, lending to families, can be defined that way, as opposed to businesses doing something more complex and, you know, up there in the derivatives market or something.
Thank you.
Can I add one thing about loan closings, which is the CFPB just undertook a big study of loan closings because they were very concerned about that thick package of closing documents. And to their surprise, as well as, frankly, mine, they found that only a handful of those documents had to do with federal regulatory requirements. The vast majority, more than half of those documents, are required by the banks themselves. So if they want to get rid of them, that's actually in their control. It turned out not to be in the CFPB's control.
Thank you for that. Mr. Eagerton, I am a big supporter of credit unions. I am a member of the ILWU credit union back in my hometown, and I've worked very closely with my credit unions, who I give great credit to for being really the community banks in most of our communities. One of the things I think we can do to help credit unions is to lift this arbitrary cap that was not a result of Dodd-Frank, but it was a result of Congress in the 1990s put on this arbitrary cap on how much our credit unions could lend. And I think that I've been a big advocate of raising that cap, and I know Ranking Member Chu and I are both co-sponsors on the Credit Union Small Business Jobs Creation Act, which would lift that cap. I know the big banks are very opposed to that, but I would like to see that happen because I think that would do more than lifting regulations to allowing our credit unions to really get in there and make those loans. Could you just tell us what that would mean if Congress passed the bill on raising that arbitrary cap?
Well, first let me start with this. I think that's an excellent idea. Most credit unions today are capped at 12.25% of their assets.
Right.
So by raising that cap, you would allow credit unions to continue to do member business loans. What most credit unions find today is that just as soon as they get the program up and running, get the staff hired, they have to stop because they meet that cap.
Right.
So I think that's an excellent idea.
Thank you very much. Mr. Chairman, I yield back.
Thank you, Mrs. Hahn. Mr. Hanna.
Thank you. Ms. Gordon, I think there's a lot going on. There's a lot of moving parts. I take these gentlemen at their word. I mean, and I also think that part of the issue that was never really addressed was the fact that borrowers are also complicit in their own problems. And the bigger the loan application, the more complex, the less likely it is that people actually understand what they're doing, especially when they're anticipating that their value of the property, as you indicated, was going to go up 10% a year, and actually didn't, and why would it, right? Things don't grow to the sky. But what I want to say, too, is that what I've noticed is that because consolidation and economies of scale, as you had mentioned, are so obvious in the banking business and seem to work so well, and I take your points about banks at the lower end needing to be more efficient, maybe look to bigger banks to see what it is they should be doing. What I see is that the role of smaller banks is even more critical now than it's ever been, because with this consolidation, larger banks are less willing, and frankly, it's not profitable for them to do the kind of banking that Mr. Kelly spoke of. And what I see is a reduction in the willingness and the capacity of people to borrow, not just because they're increasing their loan requirements, but because that it's just simply not worth it for banks to do $100,000, $200,000 loan. The internal costs are so great. So I would suggest that what Mr. Mitchell and Mr. Eagerton do and what Mr. Luck spoke about, that we should find ways to reduce burdens on smaller banks, because the entrepreneurs, as Mr. Mitchell and Eagerton pointed out, at the lower end, that's where the growth is. I mean, it's a small guy that gets big, and frankly, that's what we want. And I don't mean to make a statement here too much, but I wonder what anybody thinks about that, especially you, Mr. Mitchell. I mean, you're a small bank. Mr. Eagerton's a small bank. What do you think of that?
Well, I think you're absolutely right. As Ms. Hans spoke of, I think larger banks do want to try to benefit from an effort that really should be tightly geared towards community banks. We don't want to throw the baby out with the bathwater, but the bathwater needs to be drained significantly because it's pretty dirty. So you're absolutely right. You cannot expect a $1 trillion institution to focus on $100,000 loans. And as you reduce the number of community banks, what you end up with is fewer larger banks that can't focus on a $100,000 loan. So you're absolutely right.
And to your point about minorities, that speaks exactly to that. Go ahead, Ms. Gordon, I'm sorry.
I mean, you're posing a very, very important question, which is, if there is a problem with regulatory burden, do you address it by exempting the smaller institutions, thereby giving them potentially a competitive advantage in the marketplace? Or do you address it by getting rid of those regulations altogether, which leaves the small institutions still subject to the same disadvantages relative to large ones that they have been for a long time? And I've been very interested to hear from a lot of small institutions that don't seem to realize which exemptions they have. Not only are small institutions exempted from a number of these rules, but a number of these rules don't apply to the smallest loans. And there, I think you have real questions about how this is working.
These gentlemen know their numbers. They're not sitting here dumb. They're telling you what it's costing them. They're telling you it's a burden. So they may not be aware of everything, but they're certainly aware of the fact that spend $75,000 or $100,000 when they used to spend $20. That's what they look at. I'm sure you're correct.
No, that's absolutely true. But I have heard from banks come and tell me, I can't do this kind of loan, that kind of loan, or that kind of loan. And that's what their risk officers or their lawyers are telling them, and it's just not right.
That perhaps some loans should be looked at differently by the federal government.
Absolutely.
In a way, you're on their side.
Exactly. I completely agree that they should be exempted from a number of these rules.
Thank you. My time's expired. Thank you.
If I may, while we are not examined by CFPB, we're still subject to the rules that they write. So the exemptions are not as clear as you may anticipate that they are. We wouldn't be here if that was the case.
Thank you, sir. Thank you, sir. Mr. Payne.
Thank you, Mr. Chairman. I'd like to thank you for having this hearing, and also our ranking member, Ms. Chu. Mr. Mitchell, it's good to meet you, and thank you for those kind words in reference to my father. But in your testimony, you recommended reforming Regulation D of an accredited investor. Your recommendation will change the definition to now include the value of the primary residence in determining if a person's net worth has met the $1 million requirement to be an accredited investor. Can you tell us why this would be beneficial to small businesses and how it could increase access to capital?
Yes, sir. Number one, community banks, and particularly minority banks, we're always seeking capital, as in the case of City National.
Right.
And what the rules as they stand now, it limits the pool of those investors that we can go to for capital. And so by including the residents in the net worth calculation. It opens up the pool to just more individuals without us having to go through a number of steps, a number of hoops to offer capital to those investors.
So it would be critically beneficial. To
Absolutely.
and
Absolutely.
it would make a world of change in reference to them being able to be accredited.
Absolutely. In a private offering, which is a small offering of capital, it just opens up the pool to a number of other people.
Thank you. I know you mentioned the bank in my town, City National, on several occasions that my father and now I have struggled to help maintain viability in that community because of the work that they do on the ground every single day for people who necessarily can't walk into other institutions and even get someone to speak to them at all.
Fortunately, they have just completed their recapitalization, and they're on solid ground for the future under the direction of the NBA chairman, Preston Pinkett.
And Mr. Pinkett will sit on my forum at the Congressional Black Caucus tomorrow, and if you're in town, we're going to make sure we invite you as well.
Thank you very much.
All right. My second question is to Mr. Mitchell as well. Since I'm referencing your testimony, but all panelists can answer. Mr. Mitchell, in your testimony, you recommend community banks be excluded from the small business data collection requirement under Section 1071 of the Dodd-Frank. However, we know that there is discrimination in small business lending, and the collecting of this data in one place will specifically help our women and minority-owned small businesses. Representative Chris Van Hollen and I have recently led a letter to the CFPB director outlining the importance of this requirement. 82 members have joined us on this letter, and hope I can get several more on this committee on it because it's undoubtedly important. You mentioned privacy concerns. However, we know that Section 1071 regulations will be formatted similarly to the HMDA, which explicitly prohibits institutions from including information that will identify the applicant or borrower, such as their name, date of birth, or social security number. Can you tell the committee why the ICBA believes the community banks should be excluded from this extremely important regulation?
Well, it goes back to the fact that community banks, we actually care about our customers. And I think when you look at most of the discrimination in lending and predatory practices in lending, it has been systemically present in larger institutions. Community banks, we're here to make loans. We want to make loans. And since we are part of the community, our reputations are at stake. If we engage in those practices, so while there is a clear need to try to outlaw discrimination at any level, I don't think it's necessary for community institutions. HMDA is a very tedious, while necessary, it's a very tedious requirement, and the data points of HMDA have grown so much. It's almost impossible for institutions to comply on an ongoing basis. I mean, we spend a lot of time and money on HMDA data collection and ensuring its accuracy, and I see this as another form of that.
Thank you. I was going to try to get other members on the panel, but I will yield back.
Thank you, Mr. Payne. Mr. Luke Kamar.
Thank you, Mr. Chairman. I'm not a member of the committee. I'm just here today as an interested, concerned member of Congress with regards to this particular issue. As a former bank regulator, as a former banker, I've got some insights into this that certainly give me pause when I look at the title of the hearing today, Dodd-Frank, it's Crippling Small Lenders' Access to Capital. I see every day, in talking with all the folks in my world, you know, the banks and credit unions are impacted in a way by these regulations that absolutely is cutting off credit to everyday folks to be able to live their lives the way they like to with regards to buying homes, financing cars, providing educational opportunities for their kids, as well as business opportunities for themselves. You know, Mr. Lux, you made the comment a while ago that Dodd-Frank shrinks access by scope. Can you elaborate on that just a second?
Sure. If it's okay, I'd like to just make a general statement, and I'll
Very quickly.
and I'll
I
answer your
got 5 minutes, and you talk very slowly. I need my time.
Okay, you'll get your time back. Simply put, Dodd-Frank needs to be streamlined. Someone needs to take a hard look at this 856-page document and look at the implications of it. The only thing I'd like to say is it's a gift to academics, because my second paper was on the growth of mortgage finance in light of Dodd-Frank, and the paper that we'll be authoring in the fall will be how the underbanked have grown.
Very good. Thank you. Mr. Mitchell, I know that we have a deadline coming up here, and you made mention of it a minute ago with TRID. You know, I'm one of the guys who's been harping on CFPB to try and have some forbearance there, and they pay lip service to it, but they won't put anything in writing. I'm very concerned about this for them as an opportunity to go after people doing a legitimate job of doing the best they can and getting caught in this time frame here. Can you explain your concerns about it, or do you have concerns about it at all? I know you mentioned a minute ago.
Yeah, we have a lot of concerns about it. In fact, we had an expert title attorney come and speak to our lenders about the upcoming requirements. And while we are actually trying to shorten the amount of time from application to closing, she, in no uncertain terms, said that it would add 15 days easy to the process, and the paperwork is very difficult. Settlement companies are still trying to get their hands around the requirements, and that's pretty scary.
Yeah. Mr. Eagerton, you'd like to comment on that as well?
The CFPB qualified mortgage rule, that basically hampers our business. We're not real comfortable with that. I can remember 20 years ago making my first mortgage loan. Thinking back, that guy probably had a 45% DTI. I still see him every month. He makes his payment on time, no issues. I understand that there's some opposition at the table that says that we may or may not be exempt, but that's a very wide line between us and the regulators. So, yeah, I think that's part of it. And I also would like to see the CFPB have a 5-person bipartisan panel as opposed to just one person.
And, you know, CFPB is a figment of our creation of Dodd-Frank here, and it's very, to me, it's the most dangerous agency in Washington because it's unaccountable. It's there's no oversight, in my mind anyway. And once the director's appointed, he's there for his term. They're making rules and regulations without very little oversight or impact. They refuse to accept comments from the outside. And so, you know, in discussing this TRID issue, for instance, with the director, I mean, we're supposed to take him at his word that he's going to behave in a responsible manner and not look at this as an opportunity to go after institutions. And it's very concerning to me, especially from the standpoint that yesterday I had somebody in my office who, it was a business, and CFPB went after them from the standpoint that within their document, one of their operational documents that they hand to a customer is a phrase. And CFPB fined them $10 million because they're anticipating doing a rule down the road that this phrase would no longer be compliant with. All of you now are going to have a crystal ball sitting on your desk or be clairvoyant in order to know what CFPB may do in the future. This is how far we've gone. This is how over the top this agency has become. This is the environment that has been fostered by Dodd-Frank, and it's doing more than crippling access to capital for our people. It's crippling the economy. I appreciate you being here today. Thank you very much for your testimony.
Thank you, Mr. Lukemeyer. Mr. Pratt.
Thank you very much, Mr. Chairman. Thank you for holding this hearing today. I think it's very interesting. I did my PhD in economic growth, and that's part of the subtitle of this hearing. We haven't talked much about economic growth, and so I think that's interesting to bring up now in some respects. I have the people of my district, Virginia 7, say Dodd-Frank is a huge burden on their businesses. I have a small business short-term lender in Culpeper, Virginia that expects to be driven out of business by the expected CFPB rule. Chairman Rice and Ranking Member Chu, I have a letter from that constituent, Brandon Payne, as well as testimony he provided to members of the CFPB Small Business Advisory Review Panel, and I would like to request that this be inserted into the hearing record.
Without objection.
Thank you very much. Mr. Payne's check cashing provides a valued service to people without other options. CFPB is trying to eliminate this market, and I think we've heard similar testimony from the folks with us here today. The gentleman in business here, I mean, I hear Ms. Gordon at the end of the table from the government and the regulators saying they're trying to make your life easier. And you guys in economics are called the data points, right? So it doesn't get any more real. You're the data. What do you have to say to the government in terms of them making your life easier? It seems to me you're giving Ms. Gordon some very clear testimony on how the regulations are hurting people, and yet we're kind of talking by each other. And so there's got to be some give and take, and so I'll pose that question to you in a minute. I want to get to the economic growth piece also. In Econ 101, you get a nice graph at the beginning of your textbook that's got robots on it and pizza down on the other, right? One's an investment good and one's a consumer good. And that's your first chart you learn because it has to do with economic growth. And so as a society, you can either invest in robots and grow in the future or have a pizza party. And this country's been having a pizza party for a few decades now, and our growth rate is suffering because of it. I think on that graph you can also juxtapose, instead of having robots and pizzas, you can have robots and three-ring binders. And so when I studied economic growth, growth in its simplest form at the cross-country level is usually a function of capital, stock, human capital, education. You can measure that in some ways, R&D, you can throw in there something like that, and technology, and you can throw labor in there, right? So growth is caused by those things. Now, I'm trying to get the government to understand, and maybe you guys can help me make this argument, but when you're hiring employees to read through three-ring binders and do all the regulatory burden, you're not hiring someone else with human capital that can help you get capital and technology, et cetera, to grow the economy and grow your firm. I think that's about as straightforward a way as I can put it. And then the expert on regulation says what you guys should be doing. I wrote you should be, you know, if you small business people were more clever, you'd be doing more marketing and technology and taking risks, et cetera. And so that's our guidance from the regulators, is that you guys, you know, you should be doing more marketing and technology and taking risks. But I'm trying to show this trade-off that if you're constantly buying three-ring binders and people to go through three-ring binders day after day after day, you can't hire the person in marketing, and you can't hire the person in technology, and you're going to be reluctant to take risks. So Mr. Mitchell and Mr. Eagerton, can you tell us how profound is the impact on your businesses when you have to pay for this regulatory thing, and speak to Ms. Gordon and the regulators so they get a sense of, hey, this is real. There's a real trade-off that's hurting us, and we're going to go out of business.
I'll speak very briefly as an econ major. I certainly appreciate your analogy, and the extension of credit and the multiplier effect is what makes the economy go. It's not really actually rocket science that small businesses create most of the jobs, and small businesses get most of their credit from small community financial institutions. It's pretty much as simple as that. And the amount of time that we spend on compliance is tremendous. 120 people, you know, a third of their job is compliance, and that does not produce loans and move the multiplier effect.
They're not moving, right?
To grow the economy.
You buy that, Mr. Egerton? Is it?
I agree with him 100%. And, you know, compliance is just, it's really, the pendulum has swung way too far for our institution. We don't have a 3-ring binder, but what we do is we have a boardroom, okay? And so I assign 3 staff members to go in and look at Dodd-Frank Act. They come out a week later and they go, here's a stack. It's 800 pages. I'm sure you've seen it. But here's a stack that's going to affect our institution, and this is what we need to do about it. So during that time, understand that I have a staff of basically 20 people, okay? So for that week, they're basically out of commission. And then they're going to come back with a plan of action of what we're going to do. I really feel like that we're getting away from helping people and making sure that we make the loans that Washington agrees with. And I think that needs to change.
Thank you guys very much. Thank you.
Thank you, Mr. Bratt. They have called for votes. You have anything you want to add? We've been talking about babies and bathwaters, and I want to finish this up just looking at what's swimming around in our bathwater right now. The graphs I started out with, the big banks are still getting bigger. Small bank formations are at 80-year lows. Net business startups are at 80-year lows. Home ownership is at 50-year lows. Workforce participation is at 30-year lows. We're in a bad spot. And I think Dodd-Frank and just general banking regulation has a lot to do with that. I think we've vastly diminished access to capital in this country, and we need to deal with it, or it bears poorly for our economy. Thank you for being here. Thank you to the witnesses. Thank you for those who came and participated in the audience, and the meeting's adjourned.